the Markowitz optimization using two stocks and how you can plot the efficient frontier, the capital allocation line, and the indifference curve of a portfolio using Microsoft Excel. We have some input data, we have stock 1 and stock 2, and a mean return of 8% and 7%. We also have the standard deviation, a covariance, and a risk-free rate. Here we have the utility function that is used, with A as the parameter for the level of risk aversion of the investor. At first, we want to compute many portfolios. So we start here with 130%, and let's say here we have this portfolio minus 10%, and we do this a few times. We know that the portfolio in overall is equal to 100. So we can say the weight of stock 2 will be 1 minus the weight of stock 1. Now we can do this for everyone. And now we have a few portfolios. So this is one portfolio, this is one portfolio, and so on. And now we can compute the expected return of the portfolio using this formula right here. So the expected return of a portfolio is just the weight of the portfolio multiplied with the mean return of this stock. So let's start with the 8%. We have to log the cell times the weight of stock 1 plus the mean return of stock 2. Also log this one using F4 times the weight of this stock. Now we can just double click on this point right here. Oh, we can't. And we have a few returns computed. Now we go on with the standard deviation. The standard deviation for a portfolio with two stocks is used. There we have this formula. So we start with the square root of the weight from stock 1 to the power of 2 times the standard deviation squared, so this will be the variance, and we have to log this cell as well, times 2, plus the weight of stock 2 squared times the standard deviation, also logged squared, plus 2 times the weight of stock 1 times the weight of stock 2 times the covariance. The covariance also must be logged. So here we get the standard deviation. Now we can double click on this icon to get every standard deviation for every portfolio. With these numbers, we can now compute the Sharpe ratio. The Sharpe ratio is just the excess return of the portfolio, so the expected return minus the risk-free rate divided by the standard deviation of the portfolio. So this will be the expected return minus the risk-free rate. The risk-free rate must be logged and divided by the standard deviation. Okay, now we have computed all the relevant data. We have here our optimal risky portfolio this portfolio has the highest Sharpe ratio, and we used these formulas right here. And now we have to plot our efficient frontier using this data. So we go to Insert and we use the scatter plot. And now we need some data for our plot. So we select data. We start with the name. This is the efficient frontier. Then we have the x values. X values will always be the standard deviation, and the y values will always be the expected portfolio returns. So now we can plot this. And you can format this table like how you want. And we can put here a solid line to connect the dots, and this will be our efficient frontier. Now we can compute the capital allocation line. We know that it must start at 2% because that's our risk-free rate when an investor has 100% in the risk-free rate, and it should go through the optimal risky portfolio, because then the investor has 100% in the optimal risky portfolio. And when we go over this point, then we are borrowing some money. So we can have a look at what is if we invest 200% in the optimal risky portfolio. So let's compute the return if we have a weight of 0% in our optimal risky portfolio. So we have the weight times the return of the optimal risky portfolio, that must be logged, plus 1 minus this weight times the risk-free rate, so 2%, and this must be logged too. So we have 2% because we have a weight of 0% in the optimal risky portfolio, and here we are invested 100% in the optimal risky portfolio, so our expected return equals the optimal risky portfolio. For the standard deviation, we know that the risk-free rate has a standard deviation of 0. So we just need this weight times the standard deviation of the optimal risky portfolio, log this to get our standard deviation from this portfolio. Here we have 0 because we are invested 100% in the risk-free rate, so we have no standard deviation, so no risk, because the standard deviation is a measure for risk. And now we have all the data we need. We have 3 points, and the line between these points is the capital allocation line. So we must select the data. Let's name this one capital allocation line. X values is the standard deviation, y values are the expected portfolio returns. Plot this, and here at this point we are here at the optimal risky portfolio. We can compute the optimal complete portfolio. Here we have the preferences of the investor. So we need a starting weight. Let's say 50% in the optimal risky portfolio and 50% in the risk-free rate. And here we need this for the Excel solver. So we need here the sum of these weights. They equal 100%. So the return here is the return of our expected optimal risky portfolio. Here we have a standard deviation of 12%. For the risk-free rate, we have a return of 2% and a standard deviation of 0. And the return of the portfolio is just the weight times the return plus the weight in the risk-free rate times the expected return from the risk-free rate and the standard deviation is just the weight of the optimal risky portfolio times the standard deviation of the optimal risky portfolio. Now we can compute the Sharpe ratio. This is the expected return minus the risk-free rate, so we have an excess return divided by the standard deviation. So, and we can see that this Sharpe ratio equals this one. And now we can compute the utility the investor gets from investing 50% in the optimal risky portfolio and 50% in the risk-free rate. Here is our utility function. So we start with the expected return. This is our expected return minus 0.5 times A. A is the level of risk aversion. Let's say this is 3 in this case. Times the standard deviation of the portfolio squared, so we have the variance. This is 0.04. And now we use the Excel solver to reset all. Yes, we want to max our utility by changing the cells. So the Excel solver is allowed to change the weights to get a maximal utility, and we have a constraint. The constraint is that the weights are equal to 100. Let's put this away and solve. If you're not allowed to short sell, you just keep this. So here are the results: 111% and minus 11%. This means we borrow money and invest more than 100% in our risk-free, in our optimal risky portfolio, sorry. And now we can plot where this is. We know 100% is here, so this must be somewhere in this range. But let's just plot this. We have to select some data. So we go with the plus to make some new optimal complete portfolio. X value is, you know it, the standard deviation. Y value will be the return. Plot this, and here we have it as we expected it to be. And now we can plot our indifference curve that represents the preferences of the investor. The utility function will be right here. We know this point here, the optimal complete portfolio, is at the tangency point of the indifference curve. On the indifference curve, we have all portfolios that give the investor the same utility. Let's start with a few standard deviations to plot this. 3%, and we go to 30. Why 30%? Because here it goes to 30%, so I want to know all the values that are here. And now we have to fix the utility, because on an indifference curve we know that the utility is the same. We can just use the formula for the utility and solve for the expected portfolio return. So the expected portfolio return of this one will be the utility. This must be, that was not correct. This is a utility that must be fixed. So plus 0.5 times A was 3, and times, I think I'm in the wrong cell. Yes, I am. The utility is this one, and the return, this is what we want, is the utility. Now this is fixed. Okay, perfect. Plus 0.5 times A was 3 times Okay, I can click. So this is 19 and squared. Now we can just double click on this one to compute all the portfolio returns for this given standard deviation and this given utility. Now we can prove it because if we calculate the utility using this return and the standard deviation, we should get 0.05. And let's prove, or let's see if this is the case. We have the expected return minus 0.5 times 3 times standard deviation squared, so we get the variance, 0.05, double click to get everything computed, and this is correct. So now we can plot our indifference curve. We select the data, indifference curve. X values, I think you heard it the first time in this video, is the standard deviation. Y values will be the expected returns, and we can plot this and maybe format the data series. We don't really need these markers. Can we make this perfect? And now, okay, next try. I want here a dashed line, so let's see. Okay, now finally I got this, and here we can see the green point was our optimal complete portfolio, and we can see this is indeed the tangency point of our indifference curve with the capital allocation line. Yes, that's it. This was the video. Thanks for watching.